This is not a signal and not a forecast. Since this structure was observed, multiple hourly candles have printed, and despite that time passing, acceptance has not changed. At published time, price is still interacting with the same reference, so the question remains unchanged. We start with the 1-hour chart, because this is where the market made its intent clear without saying it directly. The February 1st Asia session did not open into neutrality. It opened with a large downside gap, and that gap was not random. It followed a failure that had already occurred during the January 29th U.S. session, when price moved below the December 18, 2025 U.S. session retracement anchor and did not reclaim it before the session ended. That matters because once a U.S. session ends with a structure unreclaimed, the next session does not begin from balance. It inherits the unresolved condition. In this case, that inheritance expressed itself through absence rather than continuation. Price did not grind lower. It did not test and fail again. It simply opened lower, skipping the process that would normally allow structure to adjust gradually. Now look at where the 1-hour candles are forming relative to the means. Price is not just below the 20 MA. It is not just below the 120 MA. It is far from both. That distance changes the nature of mean reversion. When price is extended but still close to a mean, the market can repair that extension quickly, often through a sharp V-shaped response. But when distance becomes large, and when that distance is not immediately challenged during the Asia session, mean reversion shifts from speed to duration. And that shift is critical here. There was no V-shaped response during the Asia session. Instead, price remained displaced, which tells us that if the mean is to be revisited, it is more likely to happen through slow rotation rather than a sudden snapback. This displacement also carried higher timeframe consequences. As price remained far from the 1-hour means, distance to the weekly 120 MA expanded further. At that point, separation stopped being a temporary deviation and became a condition the market must either tolerate or slowly work off. Volatility behavior confirms this transition. On the 1-hour chart, short-term Bollinger Bands opened aggressively, with both upper and lower bands tilting sharply. That tells us price moved faster than structure could adapt. At the same time, the long-term Bollinger upper band initially opened with a strong slope, then began to press downward again. The lower long-term band, however, maintained a steep downward angle. This combination is important. It tells us volatility expanded, attempted to stabilize, but did not reset. Even though price briefly traded outside the lower long-term band, it rotated back inside. That move back inside is not acceptance. It is containment. RSI fits into the same story. Momentum dipped sharply, attempted to stabilize, and began to lift. But that lift occurred while price remained far from the moving averages. Momentum is recovering faster than structure, which is exactly the condition that produces time-consuming repair rather than immediate resolution. So the 1-hour chart is not describing direction. It is describing consequence. A failed reclaim produced a gap, and the gap produced distance, and distance handed control to time. Now we step down to the 15-minute chart, not to look for signals but to see how the market is living inside the 1-hour condition. The 15-minute chart does not contradict the higher time frame. It repeats it. After the Asia session gap, price did not accelerate lower. Instead, it attempted to stabilize through a series of short rotations. Each attempt followed the same pattern. Price lifted slightly, approached the short-term mean, hesitated, and slipped back. Then it tried again and failed again. This is not rejection in a single moment. It is rejection through repetition. That repetition matters more than the size of any individual candle. Look at the relationship to the 15-minute 20 MA. Price approached it, stalled, slipped below, approached again, and stalled again. At no point did it reclaim the mean and build acceptance above it. That tells us the market is not rebuilding structure, it is testing it and failing quietly. Bollinger behavior adds another layer. Short-term Bollinger Bands expanded sharply during the initial drop, paused, and attempted to contract. But that contraction did not lead to balance. Instead, it led to smaller expansions that kept price rotating inside a stressed channel. This is what happens when volatility eases slightly but does not reset. The long-term Bollinger Bands on this timeframe remain tilted downward. The lower band still carries a steep slope, which tells us downside pressure has not been neutralized, even though price is no longer accelerating. RSI on the 15-minute chart mirrors this behavior. Momentum dipped deeply, recovered, and then stalled near the mid-range, rather than rebuilding cleanly. This is not strength. It is stabilization without acceptance. So the 15-minute chart explains how the 1-hour condition is being processed. Not through continuation, not through reversal, but through repeated attempts that consume time without repairing distance. This brings us to the most important part of today's observation. When a market gaps away from its means and does not immediately respond, something fundamental changes. Speed is no longer the dominant mechanism. Time becomes the tool. Mean reversion is often misunderstood as a directional event, but in reality, it is a structural process. Means do not pull price back instantly when distance is large. They require participation, rotation, and repeated interaction. Right now, that interaction is missing. Price is far from the 1-hour 20 and 120. It is also far from the weekly 120. And despite that distance, volatility has not collapsed into calm. Short-term Bollinger Bands expanded, paused, and expanded again. Long-term bands attempted to stabilize, but the lower band retained a steep slope. This tells us volatility has slowed, but it has not been absorbed. In that environment, sharp reversals are unlikely to solve the problem. They may move price, but they do not rebuild acceptance. RSI reinforces this idea. Across timeframes, momentum recovered faster than structure. That mismatch is critical. When momentum recovers without structure, markets tend to drift. They rotate. They test. They fail. They repeat. This is why the absence of a V-shaped rebound during the Asia session matters so much. It was the moment where speed could have repaired distance. When that moment passed without response, the market defaulted to time. Time is slower. It is less dramatic. But it is more honest. It forces price to revisit the same references repeatedly until acceptance either forms or fails decisively. And right now, acceptance has not formed. Price rotated back inside the long-term lower Bollinger Band, but that only tells us the market stopped accelerating. It does not tell us balance was restored. The weekly 120 MA remains distant. That distance has not been paid back. And until it is, the market will continue to operate in a regime where movement happens without resolution. This is why today's structure should not be read as continuation or reversal. It should be read as work. Work done slowly. Work done through repetition. Work done through time. And until that work is complete, the same references remain active, the same questions remain open, and the most accurate stance remains observation rather than assumption.